required minimum distributions, 3 words that are costing American retirees $15,000 in penalties every single year, and most people don't even know what they are until it's too late. If you're 73 years old with a 401k or traditional IRA, you have exactly until December 31st to take out a specific amount of money, or the IRS is going to take half of what you were supposed to withdraw. Not 10%, not 20%, 25%, gone, just because you didn't know the rule. Let me show you how this destroys retirement plans and how to avoid becoming another statistic. Starting the year you turn 73, the IRS requires you to withdraw a minimum amount from your retirement accounts every single year. We're talking about traditional 401ks, traditional IRAs, 403b plans, and thrift savings plans. These are accounts where you got a tax deduction when you put the money in, and the IRS has been waiting decades to collect taxes on it. The government doesn't care if you need the money or not. They don't care if you're still working. They don't care if you've got plenty of income from other sources. At 73, you must start taking money out, and they calculate the exact minimum amount based on your account balance and your life expectancy. Miss that withdrawal. The penalty is brutal. It used to be 50% of what you should have taken. They lowered it to 25% recently, and everyone acted like that was generous. But let me tell you, 25% is still devastating. That's not 25% of your total account balance, but 25% of the amount you should have withdrawn that year. And here's the worst part, you still have to take the withdrawal and pay taxes on it. The penalty doesn't replace the requirement, it stacks on top of it. Let me break down exactly how this destroys your finances. Say you're 73 years old, and your IRA has $600,000 in it. Based on the IRS life expectancy tables, you're required to withdraw about $23,000 that year. But you didn't know about RMDs, nobody told you. Your financial advisor retired and never mentioned it. You just thought the money could sit there until you needed it. December 31st comes and goes. You took nothing. The IRS sends you a notice the following year. You now owe a 25% penalty on that $23,000. That's $5,750. Gone. Just like that. But you still have to take out that $23,000 and pay income tax on it. At a 22% tax bracket, that's another $5,060 in taxes. Total cost for missing one RMD, $10,810. Almost $11,000 lost because you didn't take money out of your own account. Now imagine you didn't catch it for 2 years. Maybe you moved and the IRS letters went to your old address. Maybe you ignored mail you thought was junk. 2 years of missed RMDs means 2 years of penalties, 2 years of taxes, and potential interest charges. We're talking $20,000 to $25,000 evaporated, and that's on a moderately sized account. For people with larger retirement accounts, the numbers get horrifying fast. An RMD of $50,000 means a $12,500 penalty if you miss it. An RMD of $80,000. That's a $20,000 penalty. And you still owe the taxes on top of that. Let me tell you about Richard from Texas. He's 75 now. But this nightmare started when he turned 73. Richard retired at 65 from his job as an engineer. He had a nice pension that covered his living expenses, Social Security coming in, and he was comfortable. He also had an old 401k from his employer with about $320,000 in it. He left it there, figured it could keep growing, and he'd tap into it if he ever needed it. What Richard didn't realize was that at 73, that 401k triggered RMD requirements. He should have taken out approximately $12,400 that first year. He didn't. Nobody from his old employer contacted him. The 401k company sent statements, but Richard barely looked at them. He was living well without that money, so why bother? At 74, his RMD would have been roughly $13,100. He missed that one too. 2 full years went by, and Richard had no idea he was supposed to be taking money out. Then, at 75, the IRS caught up with him. He got a letter stating he owed penalties for 2 years of missed RMD. The penalty calculation was crushing. Year 1, $12,400 RMD. 25% penalty equals $3,100. Year 2, $13,100 RMD. 25% penalty equals $3,275. Total penalties, $6,375. But that wasn't the end. He still had to withdraw both years' worth of RMDs, totaling $25,500, at his tax rate of roughly 24%. That was another $6,120 in federal taxes. Plus, Texas doesn't have state income tax, so he was spared there. But some states would have added another 5% to 9% on top. Total financial hit, $12,495 in penalties and taxes for missed RMDs, and because he had to take out 2 years at once, it bumped his income higher that year, which almost pushed him into the next tax bracket and increased his Medicare premiums the following year. What started as missing a rule he didn't know existed cost him over $14,000 and cascaded into additional costs. Richard told me he felt sick for weeks. That was money he'd worked 30 years to save, money he'd sacrificed for, invested carefully, and watched grow. And it vanished because he didn't know about a rule the IRS doesn't exactly advertise. The mistake Richard made is common, but there are others that catch people just as badly. A lot of retirees tell me, "I don't need the money, so I'm not taking it out." That's not how RMDs work. The IRS doesn't care about your cash flow needs. They want their tax revenue, and they're going to force you to create taxable income whether you need the money or not. People forget about old employer 401k plans constantly. You worked somewhere for 5 years back in the 90s, left the 401k there, and forgot about it. You've been managing your IRA and taking those RMDs properly, but that orphaned 401k, it has its own RMD requirement, and missing it triggers the same penalty. Some people think Roth IRAs have RMDs. They don't, at least not while you're alive. Roth IRAs, funded with after-tax money, don't have required distributions. But Roth 401 kiloseconds do have RMDs, which confuses people. If you've got a Roth 401k, you either need to take the RMD or roll it to a Roth IRA to avoid the requirement. Another mistake is taking your RMD from one account when you have multiple IRAs. You can calculate the total RMD and take it all from one account, and that's fine. But if you have an IRA and a 401k, you must take the RMD separately from each. People take the full amount from their IRA and think they're done, but the 401k RMD still needs to happen. Miss that, and you're penalized. Calculating the RMD wrong is surprisingly common too. The IRS has different life expectancy tables depending on your situation. There's one for most people, one if your spouse is more than 10 years younger and is your sole beneficiary, and another for inherited IRAs. Use the wrong table. Take out too little, and you've missed your RMD, even though you thought you did it right. So how do you avoid this disaster? First, set up automatic withdrawals. Most IRA custodians and 401k plans will calculate your RMD and automatically withdraw it on a schedule you choose. Set it for December 1st every year. That gives you a buffer in case something goes wrong and you're not scrambling on December 30th. Consolidate your retirement accounts. If you've got 4 old 401 kiloseconds from different employers and 2 IRAs spread across different banks, bring them together. Roll those old 401 kiloseconds into one IRA. It makes tracking easier, calculating simpler, and you're far less likely to forget an account exists. Here's a strategy most people don't know. Qualified charitable distributions. If you're 70 and a half or older, you can donate up to $105,000 directly from your IRA to a qualified charity, and it counts toward your RMD without being added to your taxable income. Let's say your RMD is $20,000, but you donate $15,000 to your church through a QCD. You only have to withdraw $5,000 as taxable income. You've satisfied the RMD, supported a cause you care about, and reduced your tax bill. It's one of the best strategies for charitably inclined retirees. There's a special rule for your first RMD year. Normally, you must take your RMD by December 31st, but the year you turn 73, you can delay it until April 1st of the following year. Sounds great, right? Be careful. If you delay that first one to April, you'll have to take 2 RMDs in the same calendar year, the delayed one by April 1st and the current year's by December 31st. That's 2 withdrawals, 2 taxable events, potentially pushing you into a higher tax bracket and affecting Medicare premiums. Most experts recommend just taking your first RMD in the year you turn 73 and avoiding the double up. If your retirement accounts are over $500,000, hire a CPA to calculate your RMDs. Yes, the IRA custodian will do it, but they're calculating based only on the accounts they manage. If you have accounts elsewhere, their calculation is incomplete. A CPA looks at your entire financial picture and makes sure every account is handled correctly. Spending $500 on a CPA is nothing compared to a $15,000 penalty. RMDs are one of those rules that seem designed to trap people. The penalties are severe, the calculations are confusing, and the IRS doesn't send you friendly reminders. They just wait for you to mess up and then hit you with fees that can devastate your retirement savings. But here's the thing, it's completely avoidable. Every single penalty, every dollar lost to RMD mistakes, comes down to not knowing the rules or not planning ahead, and now you know. If you're approaching 73 or you're already there, take action today. Log into every retirement account you have, check your balances, call the customer service line and ask if they calculate and automatically withdraw your RMD. If they don't, set it up. If you're not sure how to calculate it, talk to a financial advisor or CPA before the end of the year. And if you missed an RMD in a prior year, don't panic and don't ignore it. The IRS has a process for correcting missed RMDs. You can file Form 5329 and request a waiver of the penalty if you have reasonable cause. Sometimes they grant it, especially if it's your first offense and you correct it quickly. But you have to act fast. Richard eventually got a small portion of his penalty waived because he could prove he didn't receive the statements at his new address and corrected it as soon as he found out. But he still paid over $10,000 in penalties and taxes. That's $10,000 he'll never get back. Don't be Richard. Don't let the IRS take your money because of a rule you didn't know existed. Check your accounts, set up automatic withdrawals, and protect what you spent a lifetime building. December 31st is the deadline, and once it passes, your money is gone.